Awesome. Wrapping up thing number three and moving on to thing number four, Gary. We've talked about this in the past couple months and episodes. We have it here again. Retail earnings revised down for a couple companies we'll talk about here in a minute, further leading us to the sentiment that the consumer just is not doing well. Thing number four, Gary, the consumer keeps struggling.
Yeah, so Rob, this is somehow the third week in a row we have been telling this story where, throughout earnings season, we have seen, pardon me, we've seen um, pairs of retail companies reporting earnings. And we saw higher priced Target have a bad quarter and lower guidance. Lower priced Walmart did really well. We saw a week ago luxury, the providers of luxury goods not doing well, taking down estimates. Luxury buyers are now looking for used product, discounted product. But again, lower priced companies like Costco and Walmart doing really well. Well, last week what we got were diverging reports between American Eagle and Foot Locker, two mall-based full-price retailers that had bad earnings reports. Their revenue growth was somewhere between zero and negative. They lowered estimates. They lowered estimates for their gross margins, saying they didn't have pricing power. And on the other side of that, discounter, Dollar Tree, beat earnings estimates and tightened its sales growth range. Instead of going through all the numbers, I'll just tell you that they're projecting 5% revenue growth, which far exceeds what we're seeing at full price mall retailers. So, Rob, again, the story here is that the full price retailers are lowering sales and margin estimates, lowering earnings estimates, suffering a bit. The consumer's backing away from those purchases. The discounters, they're having good quarters. They're raising guidance, tightening guidance ranges, beating earnings estimates. There is definitely a shift in the consumer toward the discounters and away from discretionary purchases toward the necessities.
Yeah, and Gary, I know we see with inflation, right, the wealthy, those with discretionary income, right, impacts them the least. And in certain instances, a lot of times can be beneficial for those on that end of the wealth curve. Same thing that we're seeing here is that inflation is just the constant theme, right? Inflation is what's driving all of this and is the root cause of what we're seeing consistently with these weakening and soft retail markets.
Rob, you've got it exactly right. You understand this perfectly. Honestly, if we can't have Judy Shelton at the Fed, I'm sending you in. Wait, I don't have that power. All right, sorry, I would. But
All of one
here's
mandate.
yeah, exactly right. Just give me power for a day.
Close the doors.
Yeah, right. Close the doors, put a lock on it,
Yeah,
and call me like
burn it down.
mission accomplished. Right? No, don't burn anything. We're not. It was an expression. It was just an expression. Nobody's burning anything. We're not for violence here or arson. It was just an expression. Anyway, um, the key thing, Rob, and I've talked about this a lot. One of the things that makes me angry, and I know we're not supposed to use those words. We're not supposed to say we're angry, we're upset. I am, is that so many of the policies out of Washington, where they claim they are to harm the wealthy and lift up the poor and help the poor, have the opposite effect. And this is a perfect example of this. So, the reason we started to get so much inflation was because the Fed threw trillions of dollars of stimmies at us. And people are like, oh my God, this is great. Free money. Well, guess what happens? If you're wealthy, you already owned your own home. You have a credit rating that starts with an 8, and you could have gotten, all the way through the end of 2021, a mortgage right around 3% pre-tax. That works really well. And so the dollar value of your home goes up, of this hard assets goes up, but the purchasing power of the money you owe on your mortgage goes down. Like I've talked about this a million times, but my monthly mortgage payment is locked in for 30 years. So I write a check every month now, but now imagine what the value of that check will be in 15 years, 20 years, 25 years, right? Much, much lower. The wealthy can do things like buy automobiles and watches and Bitcoin and gold and other hard, not easily replicated assets that go up in value. And the ones who are really smart use leverage to do it. They own stocks, which have done really well. They can use leverage to do that. And the advantage of that is you own assets that go up in value as the dollar depreciates, they go up in dollar value. But the money that you owe becomes worth less. So the wealthy do fine. And again, one of the things that I spend so much time doing is helping deep knowledge investing premium subscribers make money from things like this. All the things that cause everybody to be miserable, we find ways to make money from it, right? And by the way, you do not need to be wealthy. You just need to know what to do. We help people, sometimes people who have, just a few tens of thousands of dollars in a Schwab account or an E-Trade account. But now, Rob, let's talk about what those stimmies did to poor people. A lot of those checks that got sent out were for $1,600. And you can say, oh, Gary, you're terrible. How could you not want poor people to have $1,600? That's not the issue. So they got that check and it was really nice. And they paid off debt smart, right? And they spent a little bit on, a little bit on luxuries, but people pretty much got their balance sheets in order. They got rid of debt. The American people generally handled their stimmy checks really well. And that's great. Credit to them. I'm happy about that. The problem is with inflation, the costs, the monthly expenses for an average family might have gone up by $100, $200, $300. So at $200 a month, that's $2,400 a year. So you got a $1,600 stimmy check, but every year your your annual expenses are up $2,400. You tell me who's winning. And so Washington said, we're going to do this. We're going to hurt the rich people and poor people. We're helping you. We care about you. But somehow the opposite keeps happening. And this is why you can't trust the politicians with this stuff. That they created this inflation and, they either knew what would happen or they should know what would happen, but they're accountable for this. Nobody's holding them to account. Although in fairness, the last election did have a lot of turnover in Congress and in the White House. And a big part of that, I think, was people upset about inflation. Now, are all of them viewers of the five things? Do they understand the economy the way our viewers here do? Of course not. The show isn't that big, right? But, even without us explaining it, people got a sense that something was wrong and they needed to make a change. And so, part of Washington did get held accountable.
Yeah, I'm no math major, but looks like the example you laid out leaves a lot of people underwater, and I think that's what we saw in the latest election. People feeling it where it hurts most in their pocketbooks. This
Exactly.
is the Bitcoin to 100,000 issue. Again, please head to deepknowledgeinvesting.com. Sign up for a free subscription. Consider a premium subscription as well. Tons of value will be unlocked with a premium subscription, as well as early receipts of the five things and other premium subscriber gated material.